This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Messer and Tim Stenevec from Bloomberg Radio.
Wait till that deal come round. Don't you let that deal go down.
All right, Mike, so today was a big deal news day when it comes to drug makers. So Bristol Myers Squibb agreeing to buy schizophrenia drug developer Karuna Therapeutics for $14 billion in a fast-moving deal that does highlight the drug makers' race to fill pipeline holes here. Karuna is developing a schizophrenia treatment called KarXT that's up for approval in the U.S. and would expand Bristol's portfolio of neuroscience, which is a growing area of interest for many drug makers. With us is Laura Chico, Managing Director of Equity Research for Biotechnology at Wedbush Securities, joining us on Zoom from Chicago, alongside Mark Monks, who is our U.S. Deals team leader at Bloomberg News, on the phone in New York City. Matt, I want to start with you first here. Walk us through this deal and what investors need to know, because Bristol views this as something that would add promising treatment to schizophrenia.
Yeah, you've got to put it in the broader context. There's a race in pharma right now to get new treatments. This is a really hot area. There's about 2 or 3 different companies like this that are out there, and they're paying a fairly high price to get out front of this treatment. You're seeing this across the sector, and we can expect to see more coming ahead.
Well, Laura, I'd love to bring you in here, too. Talk to us about the actual sort of prospects for this schizophrenia treatment. I mean, obviously, such a debilitating condition for a lot of people. Is this, does Bristol's takeover of this company really imply a lot of optimism that this product will come to market and really be a breakthrough?
Yeah, thanks for having me. Absolutely. I think this KarXT is really a game changer, is the way that we viewed it. Our model assigned credit in schizophrenia, adjunctive treatment, so an add-on therapy, and then Alzheimer's-related psychosis. But Bristol's also looking to further expand out the indications there. And you often hear the phrase pipeline in a product, but this is definitely one where I think it might have really broad applications here.
Matt, I'm wondering about the sort of the broader takeaway for the biotech industry when you think about a deal like this and the smaller drug industry. When prior to the pandemic, that was the big theme, that these big drug makers, their pipelines were running dry. They really needed to start rolling up some of these more promising younger companies. Are we sort of back to that theme now in the M&A space for pharmaceuticals?
Yeah, I mean, biotech M&A is incredibly hot right now. Coming off of the pandemic, where they got the boost from the COVID-19 treatments, that revenue bump has tailed off, and I think we're back to where we were, before that all took off. And like I said, there's a couple treatments out there like this, and there's a couple different targets, and I think we're going to expect to see more of this to come.
Laura, I want to bring you back into this conversation. How do you think that shareholders on both sides view this deal right now?
Yeah, on the Karuna side, certainly I think takeout has been a theme that's been present for some time for Karuna. And we certainly had the Cerevel AbbVie acquisition not too long ago as well. So I don't think there's too much surprise here. And then from the Bristol side, this is definitely a strategy they're looking to use to deploy more growth opportunities in their pipeline. And as Matt said, this is an exciting time. Pharma has a lot of capital to deploy and pipeline gaps to fill. So I think it makes sense from both sides.
Yeah, Matt, you mentioned that premium. Wow, 53% premium to the Thursday closing price. Not too shabby. I mean, are they basically trying to, get ahead of some potential other suitors with that big of a premium?
Our understanding is that it was a fairly competitive process. I'm not going to say who else we think was around it, but there was a couple other parties, and so that's just a reflection. And you're not just seeing this in pharma; you're seeing this in other sectors, oil and gas, where you're seeing, where there's some demand and some pent-up M&A demand. People are willing to pay for really quality assets.
Hey, Laura, are there regulatory hurdles that could stand in the way?
I don't think so at this point. When you look at the schizophrenia market, there are a number of branded and generic players. And Bristol's footprint in CNS is arguably still on the come. So I think this is actually an area that would avoid significant FTC scrutiny.
Laura, I look at stories like this and I try to think, put myself in the shoes of a stock picker trying to figure out where the next one, what's the next target going to be. Are there any sort of promising product categories and diseases that you think drug makers are most interested in right now?
Yeah, CNS is definitely one that you can see today that we're getting quite a few bids here. And I think Xenon Pharmaceuticals is kind of in that bucket, focuses on focal epilepsy. But outside of CNS, I think inflammation and immunology is definitely another hot area. I think one name that we cover in that bucket would be Viridian Therapeutics, ticker VRDN.
Hey, Matt, when is the deal expected to close?
I think that they said later next year.
Right. And what else do you think is important for shareholders to be aware of, more in the kind of shorter term timetable at this point?
I would say that seeing maybe another interloper coming in, that could be interesting. While they did pay a quality price, a very high price, that it's still possible that somebody could come in and interlope here. And also that fat price, would that raise any hackles from, potential activists that, might cry foul here. Those are always just two continuing risks that we see, especially when the deals are so few and far between right now.
Matt, I understand that the Biden's Inflation Reduction Act played into the decision making on this deal. Could you tell us a little bit about how?
Oh, I don't know. I don't know how to answer that. I don't really cover that.
How about you, Laura? Is there a reason why the Inflation Reduction Act is inspiring deals like this?
Yeah, I think one of the concerns here is, small molecule drugs under the IRA are going to have somewhat shorter exclusivity because negotiations are going to start a little bit earlier versus biologics. So this is a product that's going to be a small molecule, and they will be pursuing Alzheimer's disease related psychosis and agitation with this. So there is some potential for this to be deployed in a Medicare or Medicaid population. But I do think that, at this point, it doesn't seem to be too much of a concern at this point. I think the bigger deal here is that this is a brand new modality in the schizophrenia space, and I think patients and physicians are going to be really excited to deploy that.
Laura, I know that you cover equity research from the biotech perspective, but I'm kind of wondering more broadly going into next year with different M&A activity there, if you expect this to continue to expand, like what this really tells us about markets going into next year.
Yeah, I guess for the biotech sector specifically, it's definitely been an up and down year, but there's still been fundamentals that have been pretty positive. Valuations are attractive. FDA is very productive. We had over 50 drugs approved this year alone, and we've started to catch this M&A tailwind. I do think this theme persists. Now, maybe we've gotten a little bit of pull forward from deals that might have been announced in January, but I think bigger picture, as I mentioned before, the large cap pharma and biotechs have a lot of capital on the balance sheet that they really are prepared to deploy. As assets get more mature and go through these de-risking events with data, I think that's really the gating factor for the M&A to occur. And we do have a number of later stage readouts on deck for 24. So I do think this is a continued theme in biotech.
Matt, and when you zoom out to the broader market, not just biotech, is M&A as a strategy as a whole, are we going to be back to merger Mondays, do you think, in the new year, now that the risk appetites are back, stocks are rallying again, interest rates are on the downside? Is M&A back in 2024?
I would say that we've probably hit a bottom. So we could say, 2023 has been the slowest year for M&A since about 2013. I think we're about 2.8 trillion in deal volumes, which, that's the softest since 2013. I don't think we're going to get any lower than that. You're seeing this big spate of kind of transactions in December, and this year, this week alone, I think we've seen about $100 billion in deals. We had this Bristol transaction. There was a big insurance brokerage deal. Nippon agreed by U.S. Steel. What we like to say in the M&A, coverage areas, deals beget deals. So, we're seeing that there is pent up demand for large transactions. That said, is it going to be like, is it the dam bursting? I don't necessarily think so. I think that we're just kind of seeing, large strategic transactions in a couple different sectors that, make sense for the buyers.
Laura, what I'm wondering is if you were able to ask a question to either one of the CEOs at Bristol or Karuna, what would you ask them?
I would actually be interested to see, what comes next in CNS. What are they most excited about? This has been a really interesting period to see the evolution of how we're approaching CNS drug development. And Bristol indicated today they're not looking for any additional large-scale transactions at this point, but CNS is an area of focus that they're looking to expand upon. So really be interested to understand what they see as most promising in terms of modality or targets at this point.
Well, it's great having both of you with us to walk us through this big deal. That was Laura Chico, Managing Director of Equity Research for Biotechnology at Wedbush Securities, joining us on Zoom from Chicago, alongside Matthew Monks, U.S. Deals Team Leader at Bloomberg News, on the phone in New York City. So great getting their perspective, right, when it comes to this big deal. Bristol Myers Squibb agreeing to
Merger Friday.
It is. It's a word. Usually we do this on Monday, Mike, but here we are on a Friday.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
It's the most wonderful time of the year, with the kids jingle belling and everyone telling you be of good cheer.
All right, Mike. Now that we finished up the simulcast here, we have seen a rebound in unloved corners of the market, especially at year-end, with market participation broadening out, that I know a lot of technicians were looking and hoping to see toward the final quarter of this year, and including everything from small caps to regional banks, though small caps obviously have had a tough few years here, while the Russell 2000 Value Index has underperformed the broader U.S. stock market this year. But some of those value stocks in particular have had some support over the last month or so. So what I'm wondering is the pain over yet when you're looking at some of these unloved corners of the market. So here to discuss more, John Mowrey, Chief Investment Officer at NFJ Investment Group, joining us on Zoom from Dallas. Thanks so much for joining us, John, on this Friday heading into a holiday weekend. I know you focus particularly on value investing. Where do you see pockets of opportunity in 2024 when in particular value has underperformed growth once again?
It has, and I think that, particularly what we've seen in the last few months is that investors can be surprised very quickly. A couple areas that we think are very attractively priced. The mid and small cap areas, if you think about the small cap value area for just a moment, roughly 20% of that opportunity set is in regional banks. Another 10% is in REITs and another 5 or 6 in utilities. All of those are very interest rate sensitive, which has been a very negative thing over the last couple of years because of increasing bond yields and because concerns about refinancing at those higher rates. But now there's a bit of a glide path for investors with lower rates coming through next year, as signaled by Powell. And, separate from even what Powell signaled, the bond market was already signaling this. One of the things that we were pounding the table with our investors just a few months ago was that if you look at the spread, between the 2-year bond yield, which of course is set by the market, relative to the Fed funds rate, which is set by the Fed, that spread was very historically and statistically very wide. And historically, when you see very wide spreads between the 2-year bond yield and a Fed funds rate, that signals that those need to come in. And in fact, the Fed funds rate was very elevated, the most elevated it had been historically going back over that 2-year bond yield. So the point I'm trying to make here is that the 2-year bond yield was signaling to the Fed, hey, you need to cut and you need to bring rates down. And investors should be positioned for that, particularly as we head into next year.
John, it's been such a frustrating many years now for value investors, which, I think is a tough pill to swallow for people, who read Graham and Dodd, who really study the fundamentals and, just expect value to be a winning strategy. And so many false dawns, too. Last year, it started looking like value was finally going to outperform growth again, and it just didn't last. What are the sort of macro conditions that you think we need to see that value revival really take hold and stay in charge?
Well, it's a great question. One thing I'll point to that I think is similar to the late 2000s is you have a very strong dollar. That's coincided with a lot of pressure on the emerging markets. And it's also coincided, obviously, with the Fed having to raise rates, which really put pressure on some of the value areas that tend to be a little bit more levered and a little bit more economically sensitive. And particularly when you think about many of the value stocks, it's more difficult for them to just tap their balance sheet when they need additional capital. The growth names, the Magnificent Seven, were squarely positioned to benefit from that. But I will pivot and just point out that, NVIDIA was down 67% just last year. Meta was down, similar by similar magnitude. So the Magnificent Seven were the measly seven just 1 year ago. And so things can change very quickly. And I will share just a couple color comments around value. The Russell 1000 value over the last 3 years is up 31%. The S&P is up 35%. I think a lot of people would be surprised to learn that. I think the perception is that, hey, value is really lagging. Value is almost caught up, and really the dislocations are as wide as we've seen going back to 2000. So I think that when you consider the fact they're almost tied for 3 years, and you've got tremendous valuation dislocations, and you have a Fed that is definitely going to be more accommodative, I think those all bode well to be investing in value, and particularly the banking sector, I think, is an area that is unloved. And again, I think investors would be surprised to learn that the S&P 500 regional bank sub-industry is now beating the S&P by 1,500 basis points over the last 6 months. And I think the perception is, hey, the Magnificent Seven are doing all the work. It's like, actually, you would have a much better return if you had been moving away from the S&P, the NASDAQ, moving into regional banks. Very difficult to do, very uncomfortable, but you need to be buying those straw hats in the winter.
Okay, so what are your top stock picks then?
So some of the areas that we really like, I'll actually mention REITs first. There's one office REIT that we own in particular, Alexandria Realty. Office REITs are hated, and that's understandable. The pandemic definitely has shifted the appetite for working in an office space. But what's unique about Alexandria Realty is that this particular office REIT caters to the bio companies, pharmaceutical companies, life science companies, and they simply can't move those labs. They're strategically located on the East Coast and the West Coast. For example, during COVID, many of those folks were not able to take the luxury of working from home, as we're all grateful for, because they were hardworking, looking for ways to navigate a very challenging environment. So they can't simply move offices quickly. And if you look at this particular REIT, it's trading at one of the steepest discounts in a decade. They have reaffirmed FFO guidance. They're growing their dividend, and the collection rates from their tenants are 98%. So names like that, where we see dislocations in the valuations, but not dislocations in the fundamentals, I think are set up really nicely going into next year. We've already seen a big move in Alexandria Realty. It's up 25% in the last month. I think that's just getting started. So I would encourage investors to look at some of the higher quality REITs, industrial REITs like a Rexford or like an SBAC, a Tower REIT. All of those look very attractive as we enter next year. If I were to pivot to healthcare for just a moment, Edward Life Science is a name that we really like currently. The name has a net cash position, double-digit margins, over 10% earnings growth, and really has been knocked down for a couple of reasons. First, the life science companies got very expensive coming out of COVID, and understandably so. So those have been really punished as those valuations have moved lower. And then secondarily, they've been tied into some of the biotech names that really came under a lot of pressure that also got expensive. And to boot, you have fears about the Ozempic and other weight loss drugs, and there may be less need for some of those medical devices going forward. But the reality is We don't have the ability to model that out yet. And again, if I look at the fundamentals of an Edward Life Science, they have not been dislocated. We see no change in the earnings for next year currently. So I think that's another area that investors should be looking at, life sciences.
John, everyone got so much wrong this year. Economists were convinced we were going to see a recession. A lot of people were bearish to start the year. I can't help but think, though, now as we head into 2024, I see the reaction to like this Nike outlook today and just people selling with both fists. That the sense that recession maybe wasn't canceled, but just postponed. How are you thinking about that next year? And really, how do you play defense in this market? I feel like the strategies for playing defense in this market are not what they used to be. But how are you thinking about that?
Such a great question. So I'll pivot back to last year for just a moment. So we took the very contrarian position back in October, November, and December that cyclicals were big time on sale. And we actually took our defensive positioning down to the lowest weight that I can remember. NFJ's been around for 30 years. I've been with NFJ for 18 years. So we were very overweight cyclicals going into this year based on our bottom-up process.
Right.
If I think about defensive, you ask a really good question. What I like about what we're seeing today on a bottom-up basis is, guess what? Utilities are looking cheaper.
Right.
Staples are looking cheaper. So
Hey, John.
The old classic.
We'll have to leave it at that, John. But thanks so much, John Mowrey, Chief Investment Officer at NFJ Investment.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Mike, we've been talking this afternoon, obviously, about travel, the holidays, and here's a stat for you. So AAA recently forecast that a record 7.5 million people are expected to fly from December 23rd, which would be tomorrow, to January 1st. So that would mark the busiest year-end travel season since AAA began tracking the data in 2000, and that also beats the pre-COVID record of 7.3 million seen during that same time period in 2019. So it's pretty incredible, right? When you think about where we've come since the depths of COVID.
Absolutely, absolutely. Well, we got a great guest to talk us through.
We definitely do. Who better? Brett Keller, Chief Executive Officer at Priceline, joins us on the phone from Connecticut to discuss tips for efficient holiday travel. Thanks so much for taking the time to speak with us heading into the holiday weekend here. First off, what can you tell us about when it comes to travel prices this year, given that we've seen inflation come down pretty dramatically over the last year and a half, but it seems like these ticket prices, at least for me when I've been traveling over the past couple of months, still pretty pricey here. What does this mean for consumers?
Hi, well, welcome. Thank you. Thank you for having me. When it comes to travel here through the holiday period, the overall cost of travel, unfortunately for consumers in the U.S., is still higher than last year. It's up about 3 or 4%. But it's a combination of things. When you look at airfare in particular, airfare domestically is actually down about 5%. It just still feels very expensive because we're, I think in the back of our minds, comparing it to several years ago, and prices are up materially since 2019. So you'll save a little bit on airfare. You're certainly going to save on your rental car, but you're still paying more for your hotel. Prices for hotels are still up 2 or 3% on average in the industry right now, and you're paying a lot more for food and beverage, and especially for events when you travel.
Brett, one thing I find really fascinating right now is COVID is raging again. At least anecdotally, I know so many people have caught it. One friend literally started coughing and shivering while he was on a plane.
Oh, wow.
Yeah.
I feel like everybody has that reaction, right? Just because of COVID, and then you hear it, and especially if you're the person that coughs. I've had people look at me before, too.
Yeah, especially when you're on a plane. I caught it at Thanksgiving. I started shivering at the Thanksgiving.
It kind of triggers people.
But, Brett, it just doesn't seem like it matters to the travel industry anymore. I mean, is that a fair assessment of sort of the risk of COVID right now?
Well, I think that's what the data would certainly suggest, that consumers are, for the most part, just learning to live with it like they did in the past with colds and flu. When you look at the TSA checkpoint data through airports, just for the last 3 days, each of those days has significantly exceeded where we were in 2019 by 10 to 15% and up over last year. So it certainly hasn't put a damper on holiday travel this year.
So when are the best and worst days to travel this holiday season?
Well, we're in one right now. So today would be considered today and tomorrow are certainly some of the most heavy traffic days of the holiday period. When you're thinking about returning from your Christmas vacation in particular, the 28th and 29th will be quite busy, and the day right after New Year's. So if you can avoid those days, it's a little too late for pre-Christmas travel, but as you look forward, and many consumers are doing this, with more flex travel in their schedules, and this was an extended holiday period, people are spreading their travel out a little bit more than they were a few years ago and taking advantage of their work policies. But these are some very, very busy days. The good news is the TSA checkpoint seems to be moving much smoother this year, and the airlines are operating much more efficiently this year. And if you recall, a couple of years ago and even last year, we ran into some both storms as well as just poor operations. But they've staffed up and are largely handling the traffic quite well.
Brett, I'm I think what they used to call a frugal traveler. Some may call me a cheapskate, I guess is the other way to. But when I go on Priceline, I'm looking for a deal. I'll vacation in Cleveland
place
if
to
the
go.
price is
You're
right.
looking for deals,
But
yeah.
So where are sort of the bargain? Where can I find a bargain vacation these days?
Well, if you're looking for a destination. Right now, north and south is pretty economical. So if you're going up to Canada, this may not be your time of year to go to Canada, but that is more cost effective from what it's been in the past. And going south into Mexico, Cancun had a bit of a tough run last year because so many consumers and into this year were heading overseas. They were heading to Europe. They were starting to head to Asia. And so there was less traffic heading down to Mexico. And now, those resorts are really trying to boost traffic down to their destination. And so we're seeing some really nice value heading down there. If you want to stay domestic, listen, Orlando will always be a great destination to travel from a price-conscious point of view. There's a lot of flight lift that goes down to Orlando from just about any market in the U.S., and there is one of the largest supply of hotels in the country in that city. And so that always has great value. But we've seen a lot of consumers now moving back into major metro areas. So they're heading to New York, which is a very expensive city to travel. They're certainly heading to warm destinations like Miami and Anaheim. And Las Vegas, perennially, always the number one destination in the U.S. any time of year. And typically you can find some really great value from a hotel perspective in Las Vegas.
Brett, I'm a markets nerd, as you may guess from working at Bloomberg, and I can't help but wonder about the currency market and how it influences travel. You're talking about Europe being a hot destination last year. I imagine the strong dollar was part of that. Is there sort of a correlation between what the dollar is doing versus other currencies and where the destinations start picking up in popularity?
Absolutely. Travel to Europe is materially less expensive than it was, 3 or 4 years ago. With the currency playing to the favor of U.S. consumers, you're saving, 20 to 30% on a trip just because of the currency conversion. Now, you have been paying more for airline tickets this year to get there, but hotels in general are still cost effective in many cities in Europe. And when you look over the holiday period right now, flights to Europe are actually down 20% from where they were last year. So there was so much interest in Europe moving through this year that the airlines opened up a lot of new routes, a lot of new carry there. But that's now, I think, reversing just a touch. And so there's a lot of value if you want to head to Europe today. Now, conversely, the U.S. has seen significantly less traffic from other countries coming into Europe. Part of that was COVID and many of the Asian countries shutting down and staying shut down much longer. But those are now opening up. We just haven't seen as much traffic moving back this way again, and the currency is playing a very big role in preventing that travel.
Brett, I have to pick your brain on your thoughts about the health of the U.S. economy because there's been so much skepticism, as you know, coming into this year about recession calls clearly have not come to fruition, and the economy still has remained resilient, especially on the back of consumer spending, even though we're seeing some numbers slow a little bit in the holiday quarter here. But from your perspective, how do you view the economy, especially going into 2024?
Yeah, well, in the travel industry, there's a couple of key data points we look at to understand the health of the economy. One, in the hotel industry in particular, is just looking at the average daily rate that the hotel chains and the independents are charging consumers. They have pushed those rates up considerably over the last 2 or 3 years, and even now, with some other commodities and things moving backwards, they're still pushing up on the ADRs. And the expectation next year is that hotel ADRs, meaning average daily rate that you'd pay at a hotel, is going to still be 3 to 4% up year over year. So the hotel industry is essentially saying, we understand that other prices may be dropping, but we're going to keep pushing our pricing higher. Now, the question is what will happen to demand as a result of that decision. And demand this year has been relatively healthy. However, as we moved into November, demand started to soften just a little bit in the industry here in the U.S. in particular. And so we'll see if those rates continue to stay high or if they start to bring those down for consumers. And the second, of course, is airfare. But there's a lot baked into airfare. You know, jet fuel pricing is down about 15% from where it was last year. But the cost of labor and operating the airlines is up, meaningfully. And so those kind of play against each other, and we're just not seeing quite as much of a drop in airfare. But there is a little bit shifting down there, which would mean consumers are traveling a bit less in the shoulder periods than they were in 2022 and even earlier this summer. And so there's a little bit of a sign that, hey, consumers really prioritize travel in 22 into 23. And I think now they're being a little more cautious. But just looking at the traffic moving through this week, it's still quite strong.
All right, Brett Keller, Chief Executive Officer at Priceline, joining us on the phone from Connecticut. Thanks so much for your time.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
I'm so glad you're here with me for this next segment, Mike, because you being the team leader of crypto here at Bloomberg, it's been quite a wild ride here. So just to kind of refresh where we've been the past year. So there were at least 5 arrests, multiple bankruptcies, and of course, Sam Bankman-Fried did go to jail. And if any year could have upended this sector, this probably would have been it, yet that didn't exactly happen. So crypto comeback potentially brewing here. And not too long ago, Bitcoin's value did briefly surpass 44,000 earlier this month, came back a little bit below that, but that was its highest point in more than a year. That clearly, as you know, Mike, was fueled by the anticipation over the possible SEC approval of a Bitcoin ETF. So joining us now to dig deeper into this is Anna Kooi, partner and national financial services leader at Wipfli, joining us on Zoom from Chicago. As Mike and I both know, this anticipation that's continued to build over the last few months for this Bitcoin ETF. What I'm wondering is how much of this has actually already been priced in to Bitcoin?
Yeah, so thanks for having me on, guys. I think that there's a part of it that's already priced in. I think we're going to see a bull market coming back, and I think that it's going to be a wild ride throughout the entire anticipated rebound for the ETFs as well as the regulatory anticipated changes.
And it seems like the consensus, if not everybody, believes that the approval of an ETF is a done deal, that the SEC, lost that big case against GBTC, which was trying to convert from a regular fund into an ETF, and that they've just given up fighting against a Bitcoin ETF. But we had a story today looking at how there is a lot of activity in the Bitcoin options market to hedge against a disappointment, against another rejection. Is there any scenario in your mind where the SEC could once again reject the ETFs in early January instead of approving them as everyone believes to be the case?
I think that there is a scenario that could happen. I think that's why we're seeing the options continue to go where they're headed. Just recently, you might have seen the quote from SEC Chairman Gensler, where he, is quoted to say there's a lot of non-compliance in the crypto space, and it undermines the confidence. And a lot of people have been hurt, like you referenced earlier. And so I think that the SEC is very weary as to where this might go. And although, the markets believe that they will pass it, it could also be deferred.
Talk to us also about the regulation aspect on Washington, because that's been delayed for a while here. But whenever you're speaking with some of your clients here, what are their kind of concerns when it comes from a regulatory perspective?
Right. So we just recently had the Ripple Labs case with the SEC around is the crypto a security or not. And the crypto industry is still really unclear about, what the regulatory framework is going to be. Congress has, trying to add some stability and confidence for market participants here in this space. But I think that, the regulatory shifts and everybody's really asking for the regulatory framework to be set so that folks can either participate if they'd like to, but also for those like Ripple and Coinbase has some out as well, for them to all continue to play in the space.
Anna, we've talked so much about this massive rebound in Bitcoin, 150 something percent as of now, year to date. But I think for the true crypto heads out there, they are more excited about what's going on with a blockchain called Solana and the native token Sol on that chain, up something like 800% this year. What's going on with Solana?
I think that there's just a lot of excitement around it right now. And so, as far as where it's going to head, I think we're all, here to be seen.
Yeah.
What's your thought from more of the wealth management perspective? Because when you think back, Mike, to 2021, where sort of the fervor, not just for GameStop and AMC, but especially with a lot of these coins, even beyond Bitcoin, Dogecoin here, when you're thinking of those. But from a wealth management perspective, a lot of people still very hesitant to add that as some sort of allocation toward their portfolios. How do you view this from the wealth management perspective?
Yeah, I think we all just saw BlackRock get in. Plus, they're just one of 10 other asset managers to get into the space and really look to adopt the new potential ETFs that are potentially coming out. We're still seeing their interest, right? Whether it be the asset managers setting up the new funds, as well as the 401k plans looking to allow additional opportunities and investment options for folks to get into. And so I think we're going to continue to see the increased availability to the market as the regulation continues to unfold.
Anna, to bring it squarely into your wheelhouse at Wipfli, another big story recently was the recent passage of that will allow fair value accounting for crypto assets. What does that mean for the public companies out there that actually do hold Bitcoin? Is this good news?
I think everybody is looking to add clarity around how to account for the crypto assets. It's been a long time asked by many how they should be accounting for crypto assets. So now having the new accounting standards out there for crypto assets to be accounted for at fair value will add some clarity for everybody, not only investors but also those holding it. It's going to add more volatility into the financial statements for those companies that do hold it, but it is going to at least add more clarity for investors as well as the investing public.
All right, Anna Kooi, partner in National Financial Services Leader at Wipfli, joining us on Zoom from Chicago, giving her perspective here, Mike, when it comes to where crypto potentially headed after a volatile year, but a big year in crypto after suffering a lot of pressure there last year. We'll have more coming up. Stick with us this afternoon. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It's a living thing. It's a terrible thing to lose.
Wow, this music, pretty brilliant. Our producer back there, Paul Brennan, with the hits. And as Mike and I were mentioning earlier, the forthcoming issue of Bloomberg Businessweek on newsstands today is the longevity issue. It tells some of the stories of the billions of dollars that are being spent to live longer or age slower in the never-ending quest for the fountain of youth. So today we are delving into why tech titans, venture capitalists, crypto enthusiasts, which I know Mike is eager to hear about, as well as AI researchers have turned longevity research into something between the hottest science and a tragic comedy. So this is by Ellen Huet, tech features writer at Bloomberg News, whose story Silicon Valley's quest to live forever has many warring fractions. It's featured in the longevity issue, like I mentioned, of Businessweek Magazine, available on newsstands, on the Bloomberg, and at Bloomberg.com/Businessweek. With more, Ellen will join us shortly, but also with us is actually the editor of Bloomberg Businessweek, Joel Weber, on Zoom from Brooklyn. Joel, this is a really cool story, but first, I swear I thought I saw you in the office earlier, and now you're on Zoom, so we're sad that you're not here with us, but was I wrong? were you here in the office?
No, you had me earlier. So we set out to do this longevity issue and wanted to touch a lot of different things, because what we noticed based on some stories that we had done earlier in the year is just this insatiable appetite to want to live longer, live better, and if you have a certain amount of money or a certain interest, possibly live closer to forever. So when we set out to kind of do this cover-to-cover issue, there are a number of people that we wanted to talk to. Ellen Huet was like right at the top of that list, because Silicon Valley has a lot of money and a unique obsession with anti-aging and longevity, which takes us to the sidewalks of San Francisco, where if you're a brave reporter like Ellen, you go out and happen upon people who are not asking for Mike Regan's Bitcoin. Ellen, what did you find on the sidewalks of San Francisco?
So, can you all hear me? There was some.
Yes.
I think I'm on the phone now.
You're good.
Great. So yeah, I mean, this is such a fun story, and I love this whole issue and then kind of the theme of the issue. But yeah, not just in San Francisco, although I think that's kind of where the heartbeat is. But there's this group of social activists called the Stay Forever organization, and their goal is to raise awareness about kind of the social possibility of living forever. Their idea is less about raising money for particular gene therapies or stem cell treatments or things that might extend our life, but instead they're really focused on trying to spread awareness about this possibility, trying to inspire art for people who might want to discuss the philosophical ramifications of living forever. And what they do is they take to the streets and they survey people on how long they want to live, and they carry around posters that say dying is unacceptable, don't die, death is boring, stay alive, and they're serious. They're and that's what's so interesting to me is I think they really feel like what they're working on is the most important thing that you could be doing, and that's true across not just this corner of longevity, but this whole sort of multifaceted longevity culture in the Valley and beyond.
Okay, there was a phrase that you introduced to me in the story, Ellen. I had never heard of it before. Anti-death activism. Is that the same thing as what you're talking about, or different?
Yes, definitely. And what was some of the most interesting conversations I had when reporting the story was talking to philosophers and other sort of. It's not just these people on the streets. It's philosophers who are writing books about, with titles like The Case Against Death, or, AI theorists like Nick Bostrom, who published this famous fable called The Fable of the Dragon Tyrant, in which he characterizes death as this dragon that's tormenting this kingdom. Basically, their uniting idea is that they reject that death is a good and natural part of life. They basically feel that death is, if you step back and look at it, death is bad, and that we've just come to accept it because we don't believe that it's possible to avoid it. So one of the philosophers described it to me as the acceptance of mortality is a fallacy meant to protect us from the tragedy of wanting things that we can't have. So these people are kind of psychologically masochistic is I think one way to look at it. But they really believe that they are harnessing some truth, which is that we in order to make strides against aging and eventual death from aging-related causes, we need to accept and believe that death from aging is a bad thing that we should get rid of.
All right. I got to stop here for a minute and say that if I think about living forever, Jess, my 401k just cannot afford that. So if I'm going to have to work forever, I don't know. But Ellen, I
That's
wonder.
just because you don't have crypto in your 401k.
That's right,
Mr. Regan.
Yeah, right. That Dogecoin's going to keep me going forever. But Ellen, a couple things I really got to wonder here. Like, how realistic is this in our lifetime to even really extend the average lifespan by any material amount? And B, what about the rest of us? Like, if you're a Silicon Valley billionaire who can afford, $1 million worth of, pharmaceuticals and treatments and whatnot, sure. But, is there an inequality aspect to this where only the rich will get to live forever? The rest of us, no way, but also how realistic is this idea?
Yeah, well, I mean, what's an interesting part of the longevity world in the Valley right now is that there's actually a lot of infighting. I mean, there's people who really disagree on how best to approach this. So, of course, there are these anti-death activists who like to call themselves immortalists and stuff. And they're definitely on one end of the spectrum. And on the other end of the spectrum, there's these much more conservative people who work in biotech who are running, I think that some of the other stories in the issue are touching on some of these like advancements. And I think what's interesting is you talk to those people, they say that, actually the people who talk about immortality and stuff, they're doing us a huge disservice because they're making people, they're just making people dismiss this field overall. And if you talk to them, they're like, hey, there are advancements that we feel that we can make that could get FDA approval in the next decade that could extend, health span. So not necessarily getting into the scary idea of living forever or even necessarily living that much longer, but just about the idea of extending sort of healthy life. And I think they're really trying to win people's hearts and minds through a different way, which is like FDA approval, drugs that are shown to work in rigorous settings. And the idea there, I believe, is that if these treatments work, there will be such a demand for it that the market, yes, it might start out as something that's only available to those with lots of resources, but that it will, like other treatments that we've seen for other diseases and things, it will eventually become more accessible. And so they're very aware of the image of the billionaire who spends tons of money trying to look 18 again. And I think they're very at least conscious of wanting to push back against that.
Joel, I got to say I'm a little disappointed in you. A missed headline opportunity could have been Immortalist Combat.
No,
you're losing your fastball, Joel. I'm just gonna.
It's not too late, Mike. We've got plenty of time since it's the longevity issue.
Nice. So, Ellen, you did write about how the field's leaders have been discredited in a variety of ways. Walk us through this.
Yeah. So I think one of the most interesting subcurrents of this world is that Aubrey de Grey, who is this famous anti-aging researcher, he's someone who gave a TED Talk in 2005 about the idea of longevity escape philosophy. So the idea that we may one day soon get to a place where advancements in anti-aging are moving faster than we age, and therefore you could kind of just indefinitely extend the horizon. And he's been this sort of very famous provocateur and researcher in the longevity field. And a couple of years ago, there were these two young women who are also very established researchers in anti-aging as well, who came out and said that he had sexually harassed them in sort of a mentor role. And it did raise for me this interesting idea of the way that when a group of people feels like they're working on something that is so important, like extending human life, it can often overshadow these kind of more everyday things that are quite damaging. If this is a field that you want to have more people be entering because you want to have the best researchers in there so that they can try to find the best advancements and help the human race live longer, then it is quite damaging, I think, to have an environment in which new researchers might not feel safe or might not feel welcome. But you also get the sense that people in the longevity field care so much about extending human life that they might be willing to overlook some things like that in order to get to this bigger goal.
Ellen, these warring factions remind me a little bit of the competing newsrooms in Anchorman. So if there's going to be a satire, hopefully it can be a spirited one like that. But just on how all this plays out in the real world, one of the things I wanted to ask you about was Montenegro, because there have been, and Mike, maybe this was something that you caught, there was a gathering with a Burning Man style kind of allure that was like one part crypto, one part AI, one part longevity. And, it's interesting to see something like that become longevity being like a center of that. And it feels a little bit like all this crypto money, all this venture capital interest. It's like longevity is part of that. So talk to us about the allure of Montenegro and all of that this summer.
Totally. And yeah, something that's really interesting is that crypto money is a major funding source for longevity research. Why exactly that is, people gave me different theories. I think they feel like, these people are united by the idea of kind of breaking the rules. But I think it also just has to do with the fact that Vitalik Buterin, the co-creator of Ethereum, I think is just also really into longevity. So he had organized this summer a 2-month temporary city in Montenegro that was called Zuzulu. Don't ask me what it means because they've said specifically it's supposed to mean nothing. But Zuzulu was this, 2-month gathering of, hundreds of people, as you said, Joel, crypto, AI, longevity, these were major motifs. And yeah, they were getting together to try to talk about this sort of far-flung future in which we might live forever, have this, totally new financial system. And to me, it's showing up in other places as well, this idea of building temporary cities in places where regulations might be more amenable to experimental treatments. So exactly like in Prospera, in Honduras, and in these other, you're just starting to see these special economic zones or network states. These are the terms that people use to talk about these. It's the idea that people who are gathered by this philosophy might go to a physical place and build structures and regulations that are in favor of what they'd like to pursue. And I think Zulu was an experiment in that, and I think we're going to be seeing a lot more of those in the years to come.
Ellen, God bless the tech geeks and the crypto bros out there for their big dreams. I love it. I'm on board. But I got to wonder how does the medical community fit into this? Is anyone on sort of the medical side of this on board? Is there optimism from that side of things?
Yeah, I mean, one of the companies that we wrote about in the story is called Loyal, and they make longevity drugs for dogs. And they recently got a sort of preliminary, I'd call it a preliminary FDA semi-approval. It's not like a full thing, but basically they're advancing their drugs in a way that they feel is going to point the way toward eventual drugs that might help humans. They envision a much more sort of everyday application of this. They often like to compare the drugs to statins or things that people could take every day to sort of extend their health. It's not going to be marketed as this live forever drug. So I think in terms of small advancements like that, I think there is actually a lot of excitement in the medical community for ways that could be, that we might see in the next, 10 years, just extending our health. And so, yeah, it's just interesting to see how wide the range of attitudes is on this idea. A thing that you'd think the longevity world would really be united, they're actually quite vocal in their disagreements on the best way to approach this.
Well, if you can get my dog to live forever, I'm definitely on board.
Oh, I love that. Oh, yeah. I love dogs too.
Yeah, especially large dogs live, shorter lives. I think this is where they're starting with big dogs and trying to extend their lives.
Fascinating story. Ellen Huet, tech features writer at Bloomberg News, whose story, Silicon Valley's quest to live forever, has many warring fractions. That is featured in the longevity issue, like we mentioned, of Businessweek Magazine, available on newsstands, on the Bloomberg, and at Bloomberg.com/Businessweek. And we also had with us the editor of Bloomberg Businessweek, Joel Weber, who joined us on Zoom from Brooklyn. Glad we had a chance to chat with them both about the latest edition in the magazine. But stick with us. We're going to have more coming up. This is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is The Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Jess, Menton, and Mike Regan here in for Carol and Tim today. And with just 20 minutes left to go before the closing bell, the S&P 500 has pulled back from session highs but does remain on track for an 8-week run. So who better than to walk us through the last 2 months in the stock market than Adam Sarhan, Chief Executive Officer at 50 Park Investments, joining us on Zoom from Florida. And Adam, I just want to point out that you actually correctly called the rebound in U.S. stocks at the beginning of this year, and then also back in March when we had all of those regional bank stresses. You got that call right as well, as far as what it would mean for still a resilient economy and how that was actually what was going on in the market. It wasn't concerning for those banks and actually a bullish sign for the broader market. And as we are at the end of 2023, please give us a kind of a year in review here as far as what your sort of takeaways are as you're trying to position your portfolios going into next year.
Well, Jess, thank you so much for having me on the show. It's an absolute pleasure. And yes, it's right. I'm a big fan of studying market history. And, the expression history rhymes and repeats, all that fun stuff. And you look at the stock market, the last two big bear markets were dot-com crash back in March of 2000 all the way to October of 2002. And then you had the '08 crash. Well, all right, about a year ago, it was 2022. And I looked at market history and I said, what if history repeats itself? So in October of 2002, the stock market bottomed. This is the NASDAQ 100. Let's look at the QQQ just for one index, right? And then in March of 2003, we had a new bull market that officially began, and then it rallied for the next 4 or 5 years, all the way until October of '07. And then in '08, the NASDAQ 100 bottomed in November or Q4 of 2008. But a new bull market didn't begin until March of 2009. And I said about a year ago, I said in 2022, I said, you know what? What if that October 2022 bottom on that CPI report that we all remember was indeed the bottom, not a bottom, but the bottom. And then in March of this year, I noticed 275 cup and handle patterns. It's a bullish technical pattern that doesn't typically happens in new bull markets. And 1 or 2 or 3 might be bullish, 4 or 5 might be bullish, but 275 of them, I published the report. And the rest is history. So at the time, I said this happened twice before, where the market bottomed in Q4 and then a new bull began in March of '03. And then it happened again this time around in October of '22 and then March of 2023. So the year in review, we began the year in January, had a nice rally up until February. Then early February, we pulled back. March happened. You had the regional bank concerns with Silicon Valley Bank and so on and so forth. But it wasn't enough to break the market down. We actually stabilized in March and we rallied all the way up until July. And a lot of that was due in part to 2 major factors. In 2022, the 2 major headwinds for the market were higher yields in the 10-year, interest rates going up, to put it simply, and then the dollar going up. This year, those trends, somewhat changed, where at the beginning of this year, the dollar and the yield in 10-year both fell up until mid-year. And then in July, both those headwinds came back. You saw the yield on the 10-year spike again in the spring all the way up until October. And then you saw the dollar rally as well. And then the stock market fell. Now, July to October, let's focus on that part. You had a pullback in the market. You had 3 waves down or 3 legs down. And I noted in the summer that we're forming a bullish, massive cup and handle pattern. If you look on a monthly chart of the S&P 500 and or the NASDAQ and or NASDAQ 100, let's look at the QQQ, the NASDAQ 100. And I cited at the time, I said, this is a very bullish setup. We need a handle to form. It formed from July to October. And then in November, again, the year in review, the Fed basically told us, they indirectly said, that we're done raising rates. The market just took off.
Right.
Then in this...
Well, what I'm going to ask, though, is that with all of this in the backdrop, does that make you bullish still going into 2024?
Yeah, so that's where I was going. I said in November, you had the Fed tell us, hey, we're done raising rates. In December, they signaled they're going to begin cutting rates. So you broke out of that bullish cup and handle pattern. Now focus on 2024. We had a phenomenal year in the market. And if you notice, Jess, something really important happened too, where leadership expanded. For the first 2/3 of this year, it was predominantly the Magnificent Seven, big cap tech, and semiconductors were the driver of the market massively this year. But since November and into December, after the Fed pivot, we saw a paradigm shift where we even said in one of your articles recently that inflation is no longer public enemy number one. That's number one. Number two, a lot of the areas that were repressed, think of a basketball underwater, that were held down because of higher interest rates exploded. Now going into next year, I'm of the belief that we're in the early innings of a new bull market that could last the next 3 to 5 years, if not longer. So, and a lot of leadership is expanding. It's not just big cap tech, the Magnificent Seven. We're seeing the areas that were beaten down for most of 2022 and most of 2023 really begin to lead. And I love that.
Hey, Adam, let's rewind a little bit and talk about that big cap tech, because in addition to the bullish chart situation that you pointed out, we had this sort of wild card thematic trade going on with artificial intelligence. I'm looking at the biggest movers of the year, up movers: NVIDIA up 233%, Meta Platforms up 193%, Royal Caribbean up 158%. Jess, I don't know if that's an AI play. Maybe the thinking is that if the AI does all the work, we'll all take cruises.
Right.
But Adam, I'm wondering what you think about, obviously NVIDIA's put some numbers on the scoreboard as far as AI. Some of the other beneficiaries, not so much. How much patience will investors have with this AI theme? Are they going to want to see numbers in the 4Q reports and the 1Q reports? And if they don't see them, we could get some sort of pullback in these AI theme plays?
Yeah, it's a really good point. So there's two sides of the coin here. Full disclosure, I'm long NVIDIA for disclosure purposes. And NVIDIA's earnings, if you want to see like the proof is in the pudding, last year in 2022, they earned $4.44. This year, 23, they're expected to earn $3.34. Now get ready. In 24, they're expected to earn $11.22, and 25, they're expected to earn $18.73. So to recap, in 2023, they're going to earn $3.34. 2 years later, almost $20. That is monstrous, ginormous growth. Now, other companies that are jumping on the AI bandwagon have to put up the numbers. And if they're not able to put up the numbers, this could be another fad, just like we had, by the way, many times throughout the decades in Wall Street. I won't go too far back. Just recently, we had the marijuana stocks years ago, 3D printing stocks, and all these different rages. Oh my God, things are going to change. And next thing you know, they just fizzle out and fail.
Hey, Adam, we only have about 10 seconds left, but what's your top pick to buy next year? Stock.
I'd say the individual stocks, I'd go with NVIDIA for sure.
There we go. So people sticking with NVIDIA, Mike, after the huge rally this year. That was Adam Sarhan, Chief Executive Officer at 50 Park Investments, joining us on Zoom from Florida. We'll have more coming up. This is Bloomberg.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.